Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Today, it's all about the big picture. I wanted to get an update on some of the influences on the global economy and what it means for everyday investors. Global asset manager Nuveen has more than $1 trillion in assets under management. They recently released their Global Investment Committee report looking at everything from geopolitics to the role of central banks. Now, remember, this is general information only, and you should seek professional advice before making any investment decisions. Brian Nick is Nuveen's chief investment strategist, talking to us from New York. Brian, welcome to Fear and Greed.
Nice to be here, Sean. Thanks for having me.
Let's get the big question up front. Is the US heading for a recession?
Well, we've been having that debate over the last few weeks after that second straight quarter of negative GDP growth. I think most people, myself included, who had any kind of economics training were taught that basically constitutes a recession. But some strange things about the first half of the year. We had falling unemployment. We had rising consumer spending, even after we account for inflation. So it doesn't look like a lot of the recessions that we're used to. And every recession is different in some ways. But I think the thing we have to worry about moving forward is the more traditional recession that entails rising unemployment, falling spending, falling incomes. And that's what has investors and markets the most concerned from what we can discern from the movements we're seeing in interest rates, some trepidation in the equity markets. And so that's the risk that we have our eyes most keenly focused on over the balance of this year and into next.
Okay. Central banks are always all important, but they just seem to be even more all important right now. Anything that a US Fed Reserve governor says seems to move the market. I suppose the question is, what do you think the Fed is thinking? What do you think it will do, most importantly? And then from that, where are the opportunities in terms of investing?
Well, I started my career at the Fed back in the early to mid 2000s, and the Fed said very little back in those days. We didn't have the parade of speakers who would sort of tell us what they were thinking at a given moment, and the statements were very terse. They almost didn't change at all from meeting to meeting. And now the Fed, if anything, probably tells us too much about what it's thinking. And the movements from week to week, even day to day sometimes, can be dramatic based on how not just how the markets are perceiving the data, but how they look through the prism of how the Fed will respond to the data. So the best example recently is that employment report we got for July in the US that was really scorching hot. You couldn't look at anything in that report and not see an economy that was rapidly producing jobs, higher wages across all different sectors. And the market immediately didn't seize on the fact that the economy was producing lots of jobs, but rather that the Fed would likely use this report or consider this report to be an impediment to its being able to take its foot off the brake and stop raising interest rates. Because if you have this hot an economy, how can the Fed justify slowing down rate hikes? So the market response was actually a little bit negative, and the totality of the response we've seen in the ensuing days has been mildly negative for some of the areas of the economy that we thought were looking pretty good coming into that report. So it really is all about central banks, not just in the US, but around the world. Everybody dealing with inflation, high inflation generated from energy, food prices. We know that a lot of that's emanating from the war in Ukraine, but not all of it. And a little bit of a unique situation, I'd say, more in the US and to some extent in the UK, where there's more domestically driven inflation. So rents are a concern and leisure inflation is a concern. But for much of the world, it's really more about food and energy, and we're just waiting for those costs to come back down.
Okay, so that's the macroeconomic backdrop. Let's bring it down to how investors should think about this, where there are opportunities, sort of the assets that you like. I want to talk about high-yielding bond markets. I also want to talk about public versus private markets because I think that's really interesting. But let's start with equities, which is the easiest for many of the mum and dad investors to understand. What's your take on global equities and where there are opportunities and less opportunities?
Sure. So this is not a satisfying answer, of course, but we came out neutral for our mid-year outlook on the equity markets globally. But we had a little bit of a bias toward U.S. versus rest of the world within that. And I think the reason for that is we identified U.S. as having, I think, a unique ability to resist the downdraft that comes from higher energy prices and the weight that can have on consumer spending, pulling it down, forcing people to reallocate their money from discretionary to non-discretionary. And we thought that would hit the lower income countries, specifically in emerging markets, the worst. So we had an underweight to emerging markets while we had an overweight to the US. And that's sort of how we broke things down in the equity market. Overall, we're still pretty cautious. And I say since we published the mid-year outlook at Nuveen, we had the month in July where equity prices around the world were up substantially. In the US, the S&P 500 was up more than 9%. So we're I think, using this as an opportunity to maybe even become a bit more cautious. There are opportunities certainly in parts of the market that have gotten really beaten up pretty badly. Technology, really any high growth area has taken it on the chin this year. And we think that there's opportunities, especially for higher quality companies with durable earnings growth, even the so-called sort of mega cap tech names that really performed well pre-pandemic after the financial crisis haven't performed as well this year. We think there's a strong future for those names. But if you're looking for the next 6 months to 12 months where the macro situation just seems so up in the air, we are getting, I think, a bit more tilted towards somewhat more defensive names, companies that are paying dividends, that are growing dividends, where we think they can outperform in a market that may have one more downdraft yet to go.
Stay with me, Brian. We'll be back in a minute. I'm speaking to Brian Nick, Chief Investment Strategist at global asset manager Nuveen. Okay, so we'll say cautious on equity markets. Let's move into fixed income markets and bonds. That report's quite interesting about high yield bonds, and I think you call them municipal bonds, which we'd call semi-bonds here, which is sort of those state governments and things like that. You had a bias towards those. Of course, whether or not you think the US is going into a recession and the world's going into a recession really plays on that.
It does. And municipal bonds they trade a lot like U.S. Treasury securities. They have a little bit of a more kind of wobbly component when it comes to individual investors. They're obviously, because of the tax treatment, significantly attractive to retail investors, individual taxpayers. But that can also bring volatility. If you have a strong kind of retail presence in the market, when prices are declining, there tends to be more momentum behind that because people tend to sell into declining prices and they buy into rising prices. So there tends to be more volatility in that market than, say, the U.S. Treasury market. I'd say on the corporate side, this is maybe the half measure where I wasn't quite as full-voiced enthusiastic about equities. The half measure, if you want to have exposure to U.S. corporations and the value they return to shareholders, but you're not quite as enthused about buying into the equity market after a month where they were up close to 10%. High yield is a good compromise, sort of a hybrid security between bonds. It does trade with a little bit of interest rate sensitivity, but it has that equity correlation as well. And the yields on these look substantially more attractive than they did to start the year. We call this asset class high yield, but in the beginning of the year, the yield on the U.S. index was around 4%, which I don't think we can call high yield over any time horizon beyond the most recent. And now we're seeing close to double that yield. So we think that's compensating investors in what we think is going to be a pretty attractive market for corporate credit, low default risk, not as big of a chance of significant downgrades because we frankly just don't see a severe recession ahead, the kind that would take this asset class down with it.
Okay. So on that bond spectrum, that high yield area is a place that you're happy to be in.
It is. That's sort of our middle ground between being in the safest of safe asset classes like cash and U.S. Treasuries and being sort of fully allocated in the equity markets. I think credit is a pretty good middle ground. If you're not quite sure the ground under your feet is still a little bit wobbly and you're not quite sure where to allocate, I think this is an area where you're getting paid through the yield to continue to take risk.
Okay. Now, something else in the report which I thought was really interesting was the private versus public market argument. In Australia in the last couple of years, particularly among infrastructure assets, and I'm sure this is typical of the world over, we've had plenty of private equity players coming in and buying up public assets and making them private. The big one for us was Sydney Airport here, where we had a private equity group come and take that major infrastructure play private. The thing about private markets is they're just nowhere near as transparent. They're not priced every day like an equity market is. You make the point that this could actually benefit public markets going forward simply because private markets, they haven't sort of been downgraded quite as much as public markets.
Yeah, that's right. This is a pretty unique discussion that we had back in June when we met as an investment committee in London was we don't normally think about the trade-off between public and private markets because, frankly, it's not easy to tactically allocate out of one into the other. If you, for real estate, for example, if you're going to buy a public real estate or security or REIT, the odds are that you're not going to be trading in and out of that and in and out of a real property like an apartment building or an office building. That's just not the way these markets work. They're not equivalent in many ways. Over time, I think they deliver roughly equivalent rates of return. The question is, what's more attractive now? So it's less about tactically allocating into one versus the other, and it's more about where would you put a dollar of investable assets to work today. And I think even on the private side, the folks who are portfolio managers in some of our private markets, there was I think a recognition that because of the really awful across the board public market performance this year, credit markets, equity markets, fixed income markets, that price discovery is now helping you as an investor because you've seen the downgrade, the very public downgrade that investors have made to the equity market or the credit market. And in the private markets, that's not going to happen as quickly because, as you said, most of these securities, these properties, these deals don't price every single day. And that is oftentimes part of the attractiveness of the asset class. But right now, you want to be getting into an asset class, I think, that's down 20 or 25% versus one that hasn't budged because it's not being priced.
Yeah. I must say I had never thought of that until I read the report. The other thing I just want to also mention, you talk about job security as a new consumer confidence. Explain that.
Yeah, so this is kind of the interesting thing, and I think this is a global phenomenon, but we are especially vociferous here in the U.S. about how terrible we think everything is in aggregate as consumers. When you call us up on the phone and you ask us how we're doing, you ask us how the economy is doing, pretty much the only thing that everybody in the country agrees on right now is the economy is not doing so hot. So consumer confidence is, if you believe people who are answering these surveys, as low as it's ever been. The economy is as bad as it's ever been. That includes March 2020. Yep. That includes 2008, when we, I think, objectively can say the economy was worse, and even in the 70s and 80s when we had really rampant long periods of runaway inflation. But taking people at their word and sort of saying, okay, well, people are talking the talk, are they walking the walk? But in fact, what we are seeing is people continue to grow their spending in excess of inflation. So they're not behaving as if they've lost confidence in the economy, certainly not in their own financial situation. And I think the missing link between those two things is job security. Even if you think inflation is bad, the economy is bad, we have these 2 quarters of negative GDP growth, most people feel pretty secure in their own employment situation. Either they're going to be able to keep their job or they could move to a new job that would pay them as much or more. And that underpins the confidence that people have in their ability to grow their spending, to lower their savings rate, to dig into accumulated savings, rather than cut back on purchases in the face of inflation. That's just what we're seeing. A confident consumer can lower their savings rate because they feel like they're not really walking on too thin an edge of a knife when it comes to their financial well-being. And a not so confident consumer is probably going to say, I really think I should be saving more and spending less because I'm just not sure about how things are going.
And Brian, look, I can't let you go without, I read something on Bloomberg, I think, and you were quoted, you said something like, with money being tight, there's less to slosh into crypto. What's your take on crypto? It has come back a little bit more recently, but yeah, is there a place for crypto in an investment portfolio?
I'm not sold on crypto as part of the tapestry of asset classes that goes into, say, a pie chart for most people's financial portfolios. Part of it is I study asset class correlations and how macro factors influence things, and I can't quite pin down what makes crypto tick. Is it an inflation hedge? Well, clearly not, given how far it's fallen this year with inflation running so high. Is it a U.S. dollar hedge? Doesn't seem like it. The U.S. dollar has been quite strong this year, and crypto markets have gone the other way, so it hasn't benefited you to own it for that reason. I think it's gotten hit for a lot of reasons that other assets have been hit, which is assets that don't have a clear sort of growth path ahead, that don't pay a dividend, don't pay interest, but are just kind of promising price appreciation at some point in the future. Across the board, we've seen those get hit the worst this year, which you would expect as interest rates move up. And this was really a more popular trade back in the beginning of 2021 when people were getting extra stimulus cash and were really being told, maybe don't go out of your house just yet, wait for the vaccine. So we're talking 18 months ago now when this was sort of at the height of its popularity. And I think as the macro economy has shifted dramatically under our feet, it's become a less attractive environment for crypto. But if people really are interested and they want to own some of it, I'd say think about it more as maybe a collectible, something like art you would hang on your wall, or nice bottle of wine you're saving, and you could sort of talk about it with your friends and say, yeah, I got in at this date and this is how much it's gone up. But I think as a large percentage of your asset holdings, it's probably too volatile, and the correlations are just not predictable enough to know exactly what it's going to do for you.
Brian, thank you for talking to Fear and Greed.
Thanks very much for having me.
That was Brian Nick, Chief Investment Strategist at global asset manager Nuveen. This is the Fear and Greed Daily Interview. Remember, this information is general in nature and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.